When you apply for a modern life insurance policy, a hidden mathematical matrix instantly weighs your medical history, your habits, and your age before spitting out a premium or a flat denial. This rigid system of statistical exclusion feels like a natural law of modern finance, but it was meticulously engineered by a specific group of early 20th century mathematicians. At the center of this transformation was Emanuel Goldenberg, an actuary whose obsession with mortality tables quietly revolutionized who gets a safety net and who gets left behind. Before the widespread adoption of standardized underwriting algorithms, getting insured relied heavily on subjective character assessments and a local doctor's intuition. Goldenberg recognized that this human element was a massive financial liability for expanding corporate insurance conglomerates. In the late 19th century, the industry operated largely on guesswork, friendly relationships, and localized trust. An applicant would simply sit across from an agent, providing personal references and undergoing a very basic, often highly subjective, physical examination. A firm handshake, a steady job, and a generally healthy appearance were usually enough to secure a robust policy. Local physicians routinely covered up chronic illnesses for their neighbors, submitting perfectly clean bills of health to distant corporate headquarters. However, as insurance companies expanded rapidly across the nation, this localized trust model began to crumble under the weight of unpredictable mortality spikes. The massive financial panic of 1893 further exposed these systemic vulnerabilities, forcing insurers to pay out vast sums on policies that never should have been issued. Corporate executives realized that relying on a small-town doctor's subjective opinion was devastating their long-term profit margins. They desperately needed a cold, standardized metric to evaluate human life, stripping away personality and replacing it with pure, unyielding probability. This urgent demand for mathematical certainty paved the way for actuaries like Goldenberg to step out of the back offices and directly influence corporate policy. He began his career analyzing mountains of raw mortality data, searching for hidden correlations between seemingly minor health defects and early, unprofitable deaths. Goldenberg fiercely believed that human bias was the fundamental enemy of actuarial precision and corporate stability. The early actuarial ledgers he studied were filled with handwritten columns tracking thousands of deceased policyholders, painstakingly noting their occupations, weights, and family histories. By cross-referencing these dusty ledger entries, Goldenberg and his contemporaries began to isolate the specific, measurable variables that reliably predicted premature mortality. He spent years poring over thousands of archived death certificates, meticulously categorizing the actual causes of death against the original, often hopelessly flawed medical examinations. They soon proved that a slightly elevated blood pressure or a distant family history of heart disease carried massive financial implications over time. Goldenberg championed the radical idea that every single applicant must be broken down into a rigid series of numerical risk factors. The resulting numerical rating manuals assign specific positive or negative point values to every conceivable human trait, habit, and medical condition. An underwriter reading these standardized manuals would simply tally the points to mathematically determine if an applicant crossed the threshold into uninsurable territory. The newly developed risk classification charts featured rigid grids where a person's physical dimensions were plotted precisely against their age. If an applicant's resulting coordinates landed in a shaded penalty zone on the chart, they were automatically subjected to punitive premiums or outright denial without any human appeal. This profound shift transformed the life insurance industry from a community-based safety net into a highly profitable engine of statistical discrimination. Goldenberg's relentless push for mathematical standardization ensured that a single, centralized formula would dictate the financial security of millions of families. The era of the friendly local insurance agent evaluating your character was fading fast, giving way to the cold calculus of the actuarial table. By the early 1900s, Goldenberg's relentless crusade for data caught the attention of the largest insurance syndicates in New York. They appointed him as a chief actuary, granting him unprecedented authority to rewrite the fundamental rules of corporate coverage. He immediately moved to dismantle the remaining power of field agents, who still relied on personal intuition and local trust. To enforce strict compliance across thousands of regional offices, Goldenberg authored the industry's first comprehensive underwriting manual. This thick, leather-bound volume replaced the scattered, subjective guidelines of the past with absolute, non-negotiable mathematical laws. Agents were explicitly ordered to stop evaluating an applicant's character and start calculating their exact numerical risk score. The manual's newly invented Occupational Hazard Index categorized every American job into a rigid hierarchy of mortality risk. A corporate clerk working at a desk received a baseline score, but a rail yard brakeman was instantly assigned 50 penalty points. This printed ledger ensured that working-class applicants faced exorbitant premiums simply because of the physical dangers of their daily labor. Goldenberg then turned his attention to the precise measurement of the human body, launching a massive medical impairment study. He demanded that field examiners use standardized measuring tapes and calibrated scales, recording the exact height and girth of every applicant. The resulting weight-to-height ratio charts dictated that anyone exceeding the prescribed limit by even 10 pounds was mathematically substandard. Beyond physical health, the actuary sought to quantify moral hazard by introducing deeply intrusive lifestyle questionnaires. The underwriting department's confidential inspection reports now required neighbors to secretly testify about an applicant's alcohol consumption and marital stability. A single checkmark in the excessive drinking column of the standardized form guaranteed an immediate, unappealable denial of coverage. This rigid numerical system triggered a massive wave of rejections that swept across the country throughout the 1910s. Entire demographics, particularly low-income laborers and urban immigrants, found themselves categorically locked out of long-term financial security. Goldenberg argued that this mass exclusion was not personal prejudice, but rather the unavoidable, objective truth of actuarial science. When the influenza pandemic of 1918 struck, the brutal financial efficiency of Goldenberg's system was fully realized. The strict underwriting manuals had already isolated and excluded those with pre-existing respiratory vulnerabilities, protecting the syndicates from catastrophic payout collapses. While thousands of uninsured families faced absolute financial ruin, the corporate actuarial departments quietly celebrated their perfectly calculated risk mitigation. The financial results were undeniable and incredibly lucrative for the corporate boards observing from above. By systematically weeding out high-risk individuals, the syndicate's profit margins soared to unprecedented heights within a single decade. Competitors frantically scrambled to adopt Goldenberg's exact numerical rating system, making it the inescapable standard across the entire national market. To ensure total uniformity and prevent applicants from shopping around, Goldenberg helped establish a centralized medical information bureau. If a person was denied coverage in Chicago due to a high blood pressure reading, that rejection was permanently recorded on a master punch card. When that same person tried to apply in Boston, the shared archival ledger flagged their name, ensuring the denial followed them indefinitely. As the 1920s roared, Goldenberg refined his matrices to account for increasingly microscopic variations in human biology. His updated actuarial tables expanded to include the exact age at which an applicant's parents had died, penalizing those with short-lived ancestors. This biological determinism meant that people were now being judged, priced, and denied based on genetic factors entirely outside of their control. The actuary had successfully transformed life insurance from a tool of mutual community support into an elite, heavily guarded privilege. The mathematical barriers he erected created a deep, structural divide between those deemed statistically worthy of protection and those left completely exposed. Goldenberg sat quietly in his executive office, insulated from the devastating personal tragedies his abstract formulas manufactured on a daily basis. The ultimate test of Emanuel Goldenberg's mathematical fortress arrived with the catastrophic economic collapse of 1929. As the Great Depression deepened, desperate policyholders began dying under suspicious circumstances, hoping to secure payouts for their starving families. Goldenberg responded by weaponizing his actuarial matrices, tightening the criteria for coverage to an unprecedented, suffocating degree. He realized that a single company's strict rules were useless if desperate applicants could simply defraud a weaker competitor down the street. To permanently close this loophole, he orchestrated the rapid expansion of the Medical Information Bureau into a fully weaponized nationwide data cartel. The Bureau's centralized master index cards functioned as an invisible blacklist, recording every single medical rejection, moral hazard flag, and financial warning. The system relied on localized, covert inspection reports commissioned by the syndicates to investigate the private lives of applicants. A contracted inspector would quietly interview neighbors and employers, filling out a standardized moral hazard questionnaire to document any perceived character flaws. If an inspector checked the box for irregular financial habits or questionable associates, that subjective judgment was converted into a permanent numerical penalty. This penalty was instantly encoded onto the applicant's centralized index card, permanently fusing their medical data with secret, unverified gossip. When a new application arrived at any local branch across the country, a clerk immediately cross-referenced the applicant's name against this constantly updated file. If a matching MasterCard revealed a previous denial, the new application was automatically rejected before a doctor ever saw it. This invisible surveillance network ensured that a single unfavorable rating in one state became a permanent, inescapable financial death sentence nationwide. The applicant was never shown the secret file, nor were they ever given the opportunity to appeal or correct the often flawed data it contained. By the time Goldenberg reached the pinnacle of his career in the early 1930s, his numerical rating system was absolute industry law. No single agent, friendly doctor, or regional manager could override the final verdict delivered by the actuarial matrix. He had successfully removed humanity from the equation, permanently replacing empathy and community trust with cold, unyielding arithmetic. Goldenberg had engineered a system where corporate actuaries wielded the power of judge, jury, and executioner over the American working class. The syndicates won total control over their risk exposure, securing massive, uninterrupted profits, even while the broader national economy burned to the ground. The losers were the millions of ordinary citizens who found themselves permanently locked out of the middle class because of a minor health defect or a hazardous job. Industrial laborers, such as Appalachian coal miners and New England textile workers, were categorically denied coverage due to the strict occupational hazard multipliers. Entire immigrant communities in major urban centers were financially redlined, denied the generational wealth-building power of life insurance. They were excluded based purely on the cold calculations of the actuarial matrix, which heavily penalized the overcrowded, unsanitary conditions they were forced to live in. By the time of his retirement in the late 1940s, Goldenberg's numerical rating system was no longer just a corporate policy. It had become the foundational architecture of the entire global insurance industry, utterly unquestioned and universally enforced by every major institution. He passed away quietly in 1962, leaving behind a legacy that fundamentally altered the relationship between the individual and the financial establishment. The subjective, community-based safety net of the 19th century was permanently buried beneath mountains of statistical probability and risk aversion. Today, the physical, leather-bound manuals and paper punch cards have been replaced by sophisticated digital algorithms and artificial intelligence. Yet the core underlying logic dictating who gets approved and who gets denied remains entirely faithful to Goldenberg's original, ruthless vision. When you submit an application from your smartphone, a vast network of third-party data brokers instantly compiles your prescription history, driving records, and lifestyle habits. This digital dossier is fed directly into a modern actuarial matrix, scoring your human life with the exact same efficiency pioneered a century ago. We have completely normalized the idea that secret corporate algorithms should dictate our access to housing, healthcare, and basic financial security. The standardized general-purpose credit score, widely adopted in 1989, heavily borrowed from this exact philosophy of assigning a universal numerical value to human reliability. We are forced to accept these matrices as objective truths, rarely questioning the immense power of the invisible mathematicians who write the rules. But does this relentless pursuit of statistical perfection create a fairer system, or does it simply launder human prejudice through the sterile language of mathematics? So where do you stand on the morality of algorithmic exclusion? And do you believe access to a financial safety net should be a basic right or a calculated privilege earned through the cold arithmetic that Goldenberg pioneered? If you want to continue uncovering the hidden architects who quietly design the invisible systems governing your daily life, subscribe to our